Hi everyone, welcome to another segment on Chapter 3. This will be a brief segment and we're going to introduce equilibrium, another view. In our last segment we looked at leakages equaling injections, and that was a concept of equilibrium in the economy. This time we're going to step it up a notch and look at another view of equilibrium. But in order to understand it, we're also going to briefly introduce the aggregate expenditure and the total income approaches to measuring national income, or the level of economic activity. And these both come from the top and the bottom of our basic circular flow of income. The aggregate expenditure on the top portion of it and the income side on the bottom portion, if you go back and review. So here we go. We're going to introduce this concept called value of production. So we want to talk a little bit about the value of production. And the value of production equals the amount that producers receive, which is their sales revenue. That's not too hard to follow, which then is equal to the total spending by the buyers. So we refer to that as aggregate expenditures. So value of production is the aggregate expenditures. It's the amount that people have spent on the product, and it's at the same time the amount that the producers receive for that. Well, the value of production also equals the cost of production, but only if you include profit. Because the cost of production, well, I have to use some land maybe, I have to use labor, I have to use some capital, and I have to use entrepreneurial experience or enterprise. Those are all my factors of production. So if I add up all my factor incomes, and I add up the amount of cost for the land, the cost for the labor, the cost for the capital, and I include the profit factor, then that total is also the value of the production. So let's restate that on this next slide. If we have a look at this here, we see that the value of production is equal to the aggregate expenditures. We summarize that from the previous slide. And the value of production is also equal to the total income. So when those two are balanced or in equilibrium, aggregate expenditures must equal total income. So that's going to be our new concept of equilibrium, is where the aggregate expenditures equals the total income. Now let's pause for a second and we're going to delve into explaining national income accounting. How do we count for aggregate expenditures and how do we account for total income? Because we need those first. So on the one hand, the first way to measure national income is called the expenditures approach, like we said. And really, aggregate expenditure is what we're trying to calculate, and we just add up all of consumption, gross investment, government spending, and net exports. So we get aggregate expenditures, just the sum of those four things. So we need to figure those out in a table, and we'll be able to calculate it. The tricky part will only come when you're trying to figure out gross investment and when you're trying to calculate net exports. And that's just a hint for as you go down the road and figure these things out. So that's the expenditures calculation. We'll go into a little bit more detail what C, gross investment, G, government spending, net exports are about in the next segment. But for now, let's take a look at the other hand, the other method of measuring national income called the incomes approach. And really, all we want to do here under the incomes approach is add up all the incomes to the three major sectors. That's the incomes to households, the incomes to businesses, and to government. So if we can do that, we do the expenditure approach and the incomes approach, then in equilibrium, the aggregate expenditures will equal the total income. In this macroeconomics course, we'll introduce many new terms, but we'll introduce them slowly and we'll explain them as we go along. And as we elaborate and get into honing the definitions, you'll see that some of them can be used interchangeably depending what we're talking about. So here we talk about gross domestic product, and we define it as the value of all final goods and services produced in an economy in a period. So all the final goods and services. That's kind of like aggregate expenditures, because it's what the money is spent on, all the final goods and services. And gross domestic income, we just kind of alluded to in the last slide, it's the total incomes or total earnings received by households, businesses, and government. So in equilibrium, this gross domestic product, which kind of is aggregate expenditures, will equal the total earnings or the national income or gross domestic income of an economy. And that's what that last formula is stating. So this was just a brief introduction to these. In the next two segments, we're going to look at the expenditure model in more detail, as well as the total income model in more detail. We'll see you when we get there.